Tax Efficiency Mastery. Save big and secure your financial future. Hello and welcome to the Financial 911 channel. Today, we have an incredibly important topic to discuss: tax efficiency mastery. It's not just about saving money, it's about securing your financial future. We all know taxes can take a significant bite out of our hard-earned money, but with the right strategies, you can save big and set yourself up for a brighter tomorrow. Before we dive into the nitty-gritty, let's talk about why tax efficiency is crucial. Tax efficiency is the art of legally minimizing the amount of taxes you pay on your income, investments, and assets. It's about making your money work as hard as possible for you. Without effective tax planning, you could be leaving a substantial portion of your wealth on the table. In this video, we'll break down tax efficiency step by step. We'll explore the fundamentals of tax efficiency, key investment strategies to save on taxes, and the best tax-efficient investment tools. By the end of this video, you'll have a solid understanding of how to take control of your taxes and secure your financial future. So, let's begin. 1. Understanding tax efficiency. To kick things off, let's clarify what tax efficiency means. Tax efficiency is all about minimizing your tax liability while staying compliant with tax laws. It's not about evading taxes, it's about optimizing your financial decisions to legally pay the least amount of tax required. Essentially, it's the smart management of your finances to reduce the government's share of your wealth. Understanding the impact of taxes on your wealth accumulation is essential. Let's say you have two investors with identical investment returns, but one is tax efficient and the other isn't. Over time, the tax-efficient investor could end up with significantly more money because they've minimized the erosive effect of taxes on their investments. Before we dive deeper, let's dispel some common myths about taxes and investing. One common misconception is that taxes are beyond your control. In reality, there are numerous legal strategies you can employ to reduce your tax bill. Another myth is that only the wealthy can benefit from tax efficiency. This couldn't be further from the truth. Anyone, regardless of their income, can implement tax-efficient strategies. 2. Key tax-efficient investment strategies. A. Tax-advantaged accounts. Now, let's delve into key tax-efficient investment strategies, starting with tax-advantaged accounts. These accounts are financial instruments specifically designed by the government to incentivize saving for retirement, healthcare, and education. They offer valuable tax benefits, making them the cornerstone of tax efficiency. To make the most of tax-advantaged accounts, you should strive to maximize your contributions. If your employer offers a 401k match, contribute at least enough to get the full match. It's essentially free money. Additionally, explore options like Roth IRAs and health savings accounts, HSAs, which provide tax-free withdrawals under certain conditions. B. Tax loss harvesting. Another powerful strategy in your tax efficiency toolkit is tax loss harvesting. This tactic involves strategically selling investments that have declined in value to offset gains and reduce your tax liability. It's like turning lemons into lemonade, making the most of investment losses to lower your overall tax bill. Implementing tax loss harvesting requires diligence and a careful eye on your portfolio. It's not about panicking when your investments dip, but rather capitalizing on these market downturns strategically. C. Asset location. Asset location is a nuanced but highly effective tax efficiency strategy. It's based on the principle that different types of investments receive different tax treatments. By placing the right investments in the right accounts, you can minimize the taxes you pay on your earnings. For instance, you might want to hold tax-inefficient investments like actively managed funds or high-yield bonds in tax-advantaged accounts. Meanwhile, tax-efficient investments like index funds or ETFs can be placed in taxable brokerage accounts. 3. Tax-efficient investment tools. A. Index funds and ETFs. Moving on to tax-efficient investment tools, index funds and exchange-traded funds, ETFs, are popular choices for investors seeking to minimize taxes. These funds are designed to replicate the performance of a specific market index, which often leads to lower turnover and fewer capital gains distributions. These funds typically aim to minimize tax implications for investors, making them an excellent option for those looking to build a tax-efficient portfolio. Please remember that the tax efficiency of these funds can vary depending on individual circumstances and the tax laws in your jurisdiction. It's advisable to consult a financial advisor and consider your own investment goals and risk tolerance when selecting the most suitable funds for your portfolio. Additionally, past performance does not guarantee future results, so due diligence is essential when making investment decisions. B. Municipal bonds. Another noteworthy tool in the tax efficiency arsenal is municipal bonds. These bonds are issued by state and local governments and have a unique advantage: the interest income is typically exempt from federal taxes. In some cases, it may also be exempt from state and local taxes, depending on where you live. We'll explore how you can incorporate municipal bonds into your investment strategy, whether you're seeking income or aiming to balance risk in your portfolio. Understanding the nuances of municipal bonds can help you make informed decisions that align with your financial goals. 4. Tax planning strategies. A. Year-end tax planning. Year-end tax planning is an often overlooked but critical aspect of tax efficiency. It's like your financial year-end cleanup, where you take steps to minimize your tax bill before the calendar flips over. Year-end tax planning is like a financial checkup for your tax situation. It's a proactive approach to optimizing your tax position before the year's end. The benefits? You can potentially lower your tax liability, increase your tax efficiency, and keep more of your hard-earned money. Consulting with a tax professional can be a game changer when it comes to your year-end tax planning. They can help you navigate the complexities of the tax code and uncover opportunities you might have missed on your own. B. Retirement tax optimization. When it comes to retirement, tax optimization is paramount to ensure your savings last as long as you need them. We'll explore the critical concept of strategic retirement withdrawals. This strategy involves deciding which accounts to withdraw from and in what order to minimize taxes while maximizing your retirement income. Plus, we'll dive into the advantages of a Roth conversion and provide a step-by-step approach to optimizing your retirement income for tax efficiency. This knowledge can make your retirement dreams a reality, giving you more financial security and peace of mind. One of the most powerful tax planning strategies for retirement is the Roth conversion. This strategy involves converting some or all of your traditional IRA or 401k savings into a Roth IRA. By doing so, you can enjoy several key advantages. 1. Tax diversification. First, a Roth conversion allows you to diversify your tax treatment in retirement. Traditional retirement accounts are typically tax-deferred, meaning you pay taxes when you withdraw the money. With a Roth IRA, your withdrawals in retirement are generally tax-free. By having both traditional and Roth accounts, you have flexibility to choose which account to draw from each year, depending on your tax situation. 2. Tax-free growth. Another major advantage is tax-free growth. Once your money is in a Roth IRA, all the earnings and future withdrawals are tax-free if you meet certain criteria. This means that your investments can grow without being eroded by taxes over time. 3. No required minimum distributions, RMDs. Traditional retirement accounts come with required minimum distributions, RMDs, once you reach a certain age, usually 72. Roth IRAs, however, have no RMDs during your lifetime. This can be especially beneficial if you don't need to tap into your retirement savings right away and want to leave a tax-free legacy to your heirs. 4. Potential for lower taxes in retirement. By converting to a Roth strategically, you can potentially pay lower taxes in retirement. If you expect your tax rate to be higher in the future, it may make sense to convert some of your traditional retirement savings to a Roth now while you're in a lower tax bracket. Now, let's discuss a step-by-step approach to optimizing your retirement income for tax efficiency through Roth conversions. Step 1. Evaluate your financial situation. Begin by assessing your current financial situation. Consider factors such as your age, retirement goals, income, and current tax bracket. This evaluation will help you determine how much of your traditional retirement savings you should consider converting to a Roth. Step 2. Understand the tax implications. Next, it's crucial to understand the tax implications of a Roth conversion. Converting to a Roth will trigger income taxes on the converted amount in the year of the conversion. You'll need to weigh this immediate tax cost against the potential long-term tax benefits. Step 3. Calculate and manage your conversion amount. Calculate the amount you want to convert to a Roth IRA. Keep in mind that you don't have to convert your entire retirement account at once. You can do it incrementally over several years to manage your tax liability. This phased approach can help you stay in a lower tax bracket during the conversion process. Step 4. Set up a Roth IRA. If you don't already have a Roth IRA, set one up with a trusted financial institution. Ensure that you meet the eligibility criteria for contributions and conversions. Step 5. Execute the conversion. Execute the conversion by contacting your financial institution and completing the necessary paperwork. You can specify which investments you want to convert, and the institution will handle the transfer process. Step 6. Plan for taxes. Be prepared to pay the income taxes due on the converted amount. It's a good idea to use funds outside of your retirement accounts to cover these taxes, as using retirement funds for taxes can reduce the potential benefits of the conversion. Step 7. Monitor and adjust. After the conversion, monitor your retirement accounts regularly to ensure they align with your financial goals and tax planning strategies. Adjust your conversion strategy as needed based on changes in your financial situation and tax laws. From today's video, we've covered a lot, from understanding tax efficiency to mastering key investment strategies and tools, and even exploring tax planning strategies. Now, it's your turn. Take action on what you've learned today. Start by assessing your current financial situation and identify areas where you can improve your tax efficiency. Remember, every step you take brings you closer to financial security and your future goals. Thank you for spending your valuable time with us today. We appreciate your commitment to securing your financial future through tax efficiency. Remember, you have the power to take control of your finances, and we're here to guide you every step of the way. Until next time, take care, and here's to a tax-efficient and prosperous future. If you found this video helpful, please consider liking, subscribing, and sharing it with friends and family who can benefit from these strategies. We're here to support your financial journey, so stay tuned for more valuable content from Financial 911 channel. Thanks for joining us.